Hey everybody, Smart Silver Stacker here. Welcome to the live stream. Happy Monday as we kick off what is likely to be a very important week for gold and silver, and really for markets in general, because this Wednesday we are going to hear from the Federal Reserve regarding their much awaited pivot, the rate cuts that we've been hearing about for so long. They are going to take place in 2 days. So the question now is, will the Fed cut? Markets largely anticipate that they will. More importantly, how deep will those cuts be? Now, we're going to start off with the chart of silver here today, but we've got a lot to talk about. And I want to talk about some of the factors that will inform the Fed's decision to cut, how deep they will cut, but also why gold and silver, the worse the economy gets here, the higher the gold price and the silver price are likely to go. So starting off with silver, you can see that just this past Thursday, as market anticipation of a deeper Fed rate cut, a 50 basis point cut, began to rise, so did the silver price. And it actually broke out of a consolidation pattern that has been forming for the better part of this year. Now today, the silver price is basically flat. Looks like it put on about 1 cent today, so about as flat as you can be. Similar story in gold. Gold is at actually a new record all-time high daily close today, but only a few bucks higher than on Friday. Thursday and Friday of last week, gold was breaking out to new record all-time highs. Now, the precious metals are in a bit of a holding pattern here as we head towards the rate cuts. Now, before we get into the odds of the rate cuts and what the Fed's going to do, I want to take a look at this chart. So this is the gold price compared to the federal funds rate historically. So the candles are gold, and this pink line here represents the federal funds rate. So I want to talk about when historically the Fed has cut relative to the price of gold, because this time is actually very unique. If you go back to the 1970s, and we'll start with the 1970s because really it doesn't really make any sense to go back earlier than 1971, because that's when Nixon ended dollar convertibility into gold. So that's when the dollar entered its current phase as a purely fiat currency with no gold backing. And you can see we started off the 70s pretty low in gold. In 1971, it was 35 bucks an ounce, and then it roared all the way up to $850 in 1980. At that same time, inflation was out of control. Chair Volcker of the Federal Reserve hiked up the federal funds rate to almost 20%. It got above 19 in order to bring that inflation down. Now, they didn't start cutting those rates back until sometime in 81, and you'll notice that the gold price had already been almost cut in half by that time. Now, there were some more rate cuts and hikes throughout the 1980s, but all throughout that decade and throughout the 90s, really, gold just kind of trended sideways, didn't do much. But then when we get here to the dot-com bubble popping, that was a rate cut when gold was actually down under 300 bucks. So, it was a very low level. Moving on to the great financial crisis in 07, when the Fed began cutting in the lead up to the great financial crisis, gold was under $700. So considering the fact that the previous high from 1980 was 850 bucks, that wasn't really that high of a gold price. Of course, those rate cuts led to a bull market in gold that drove gold up to over $2,000, or right around 2,000 bucks in 2011. Then we had nearly a decade of very low interest rates following the great financial crisis. Then in 2016, the Fed began hiking rates again. We got a cut in 2019 when the overnight lending facility began to show signs of stress. But then where was gold? Gold was at around 1,300 bucks when they started cutting. So previous high 2,000 from 2011. So they were nowhere near the all-time highs. But this time, you've got the federal funds rate up here around 525 to 550. Fed's about to cut. Where's gold? Gold is at a record all-time high, and the Fed is about to begin cutting. Now, I got a comment in the chat here, says the greed index on gold is very high. Would you say a correction is due? Well, look, there could be a sell the news kind of moment when we get the Fed announcement. I think it depends on what the Fed does. If they go for the 50 basis point rate cut, I don't view that as being negative for gold or silver. If the Fed does the 25 basis point rate cut, we might get a little bit of a sell-off. I would view that as a major buying opportunity because, again, the Fed is cutting rates now at a time when inflation remains elevated, well above their 2% target, and gold is at a record all-time high. So long-term Fed rate cuts at this moment are very bullish for gold and silver. Now, silver is not at a record all-time high, but it is up about 32% year over year, so it's got some momentum behind it as well. And again, the Fed is going to be cutting in the face of elevated metals prices. Yeah, you might wait for a correction to buy your next bit of gold or silver, Big J says, but you might not get that correction. So look, if I didn't have any gold or silver, I'd probably be stacking right now. If you've got some powder dry and you're waiting for a pullback, hopefully we get one. I like pullbacks to stack too, but there's no guarantee of that. On that note, you want to get some gold and silver, make sure you check out SD Bullion, today's video sponsor. That's where I buy my gold and silver right now. New customers can get gold or silver at spot by visiting sdbullion.com/new. So let's take a look at the CME FedWatch tool. Actually, let me refresh this because this has been changing all day. But now, yeah, it went up. Look, it was 65, now it's 67. It looks like the market consensus right now is that we are going to get a 50 basis point rate cut following a number of data points that have been released over the past week or so. If you look 1 week ago, markets were only factoring in a 30% chance of that 50 basis point rate cut. So the odds of the bigger rate cut are on the rise. And what they're really balancing here is the fight against inflation, at least this is what they'll tell you, which if you ask me has just been given up now. And the fear of a hard landing and a recession for the economy. Now, if you ask Janet Yellen, there's nothing to worry about. Yellen says that the U.S. economy remains solid on path to a soft landing with no meaningful layoffs. This was last week. She said that she believes the U.S. economy is healthy and that recent months of cooler jobs data is a signal of a soft landing, not a recession. She also said that she believes job growth has slowed compared to the hiring frenzy following the pandemic reopening, but the economy is deep into a recovery and basically operating at full employment. So if you were anticipating a soft landing, Janet Yellen is about as good a contrarian indicator as they come. This should give you pause to be concerned. And I guess that Yellen, when she says that the economy is basically operating at full employment, she must have missed the revision last month to the non-farm payroll growth, which was revised down by 818,000 jobs. That's nearly 1 million jobs we were told had been created, which, whoops, they were just an artifact of the government number machinations. So certainly, I would not say that we are in the best economy of all time and the strongest recovery of all time as the central bankers and political elites seem to want to portray things. You just look at the numbers and the fact that they are faking 818,000 jobs from March 2023 to March 2024. That should give you an idea of just how strong the labor market is. Now, I guess that these three senators, Warren, Whitehouse, and Hickenlooper, who recently, actually this morning, put out a letter requesting that the Federal Reserve cut by 75 basis points. I guess they didn't get the memo about the strong U.S. economy. In fact, you can see Yellen there in the background. Of course, Yellen telling you that the economy is doing well as the Secretary of Treasury is kind of like a kid filling out their own report card, right? But these senators at least seem to understand that there is a real risk of a recession here. Now, this is modern monetary theory at its finest, of course. This is what Senator Elizabeth Warren said. If the Fed is too cautious in cutting rates, it would needlessly risk our economy heading towards a recession. The committee must consider implementing rate cuts more aggressively upfront to mitigate potential risks to the labor market. So, look, this group, they think that there are no consequences to cutting rates too deeply. They think you can simply cut rates to zero, I guess. Why not? I mean, if cutting 75 basis points is good, why not just cut, the full 525 basis points, right? And honestly, they probably would opt for that if it was on the menu. But there is the real risk of a recession and a hard landing here. And the worse that the economy gets, the greater the political pressure, as we see here, on the Federal Reserve to cut rates will be. And this is why the worse the economy gets, the higher the gold price and the silver price are going to get. This should give you an idea of what is coming when the economy really starts to show signs of weakness and after the election is over and the politicians feel like they have carte blanche to go just ham on rate cuts and money printing, and that is likely what is ahead. That's probably why Jamie Dimon, CEO of JP Morgan, has said that the worst outcome here is stagflation, and that is likely what is ahead. He said that he worries a raft of inflationary forces on the horizon, such as higher deficits and increased infrastructure spending, will continue to add pressure to an economy still reeling from the impact of higher interest rates. Now, that's likely what's going to happen here. We're going to get cutting. The government spending has become so bloated and inefficient that we're not going to get a tremendous amount of economic growth out of it. I want to show you some data that kind of confirms that. But inflation is going to get worse as a result of easier monetary policy. The inflation numbers from the government are all cooked. You can just look at the gold price, which is at a record all-time high. That should show you that the Fed's inflation fight has not been successful. Now, this is the latest monthly Treasury statement, which shows that in August, government deficits added up to $380 billion. Now, if you do a little quick math, you realize that if you were to annualize that, that would come out to an annual deficit of $4.5 trillion. This should give you an idea of why the Federal Reserve is really cutting the interest rate, because the interest on the national debt is becoming unsustainable and the debt itself is ballooning at a record pace. In fact, the interest payments on the national debt recently, in that same Treasury statement for August, hit $1 trillion in a fiscal year. And the fiscal year is not even over yet. This month that we're in right now, September, is the end of the fiscal year. So we're probably going to hit $1.1 trillion in interest. And this is why the Federal Reserve really has to get in there and cut. But it's not going to help that much. This chart from Bank of America shows you the return on investment from this government deficit spending. So before 2008, government deficit spending actually wasn't that bad of a deal. You could get $2 to $8 worth of GDP for every dollar of deficit spending you incurred. But now, following the era of QE and massive money creation, the entropy is kicking in here. The return on investment is greatly diminished. Right now, for every dollar of deficit spending, you only get 58 cents of GDP, plus you're still stuck with the debt. And as we see, the interest on the debt is mounting. So what is ahead? Well, what is ahead is massive rate cuts. In fact, I don't think that the Fed is going to be able to get away with just rate cuts. I think that they're going to have to do more than 75 basis points of rate cuts ultimately. They're going to have to get back into the business of direct debt monetization and blow up their balance sheet. They'll probably wait until after the election to kick that into overdrive because it's going to cause inflation to absolutely soar. But I don't see the outcome of the election really affecting that. That is already likely baked into the cake, given the fact that to do otherwise would require tax increases, austerity, the end of entitlement programs, just a bunch of politically unviable options. Now, let's examine some data which shows us how well the U.S. economy is really doing here, because Yellen tells us that it's deep into a recovery. Well, one of the things that has been much touted with economic growth and economic strength in the U.S. is the consumer, right? At the most recent GDP numbers, it was consumer spending that drove economic growth. You recently had the U.S. second quarter economic growth revised higher as a result of consumer spending. But consumer spending isn't up because everybody's earning so much money and everybody's standard of living is getting so much better. Consumer spending is up because of inflation, which is about to get even worse as the Fed begins to cut rates. You can see that reflected in this chart from the Federal Reserve Bank of St. Louis regarding the personal savings rate in the U.S. Right now it is at a 2.9. Now, you might notice that this chart, which goes back to the late 1950s, the only time on this chart when the personal savings rate was as low as it is today is in this window here from 2005 to 2007, the lead up to the great financial crisis. So it is highly likely that another financial crisis is about to manifest itself as consumers, one of the main drivers of the U.S. economic engine, are completely tapped out. You can see here in this story from Axios, we've got this chart which shows that credit card delinquency and auto delinquency have both risen to above their pre-pandemic levels, and they are continuing to move up at a sharp ascent. So personal savings rate is down, debt delinquency is up, massive deficits in Washington are taking place right now. Janet Yellen is selling huge amounts of debt to finance the government's out-of-control spending, and the burden imposed by the national debt is becoming, well, we're getting to the end game. Let's put it that way. You've got $35.379 trillion in U.S. national debt right now. You've got $219 trillion in unfunded liabilities. Nothing any politician is saying at the moment looks like it is going to change that scenario. So this gives you a clue as to why the Federal Reserve is cutting at a time when probably, in order to actually fight inflation, they should be hiking. It's because you can't hike in a system with this level of debt. You begin to become very unsustainable very quickly. And what they're doing now by cutting is not making it more sustainable, but what it is doing is it's kicking the can down the road once again, and it's going to make the ultimate payday that much worse when things really start to fall apart. So the worse the U.S. economy gets, the higher the gold and silver price are going to go, because the lower the value of the U.S. dollar will go as the Federal Reserve initiates this program of rate cuts and what is likely to be a modern monetary theory extravaganza when the economy really starts to show signs of weakness. So look, all eyes on the Fed. Keep an eye on the price of gold and silver. Yes, gold is breaking out to record all-time highs. I anticipate it will ultimately be going much, much higher as a result of what the Fed is about to do. Same story in silver. Now, we might get an opportunity on the day of the announcement, a sell the news moment, to get into these metals. I hope we do. I'm not buying anything right now. I'm kind of waiting, but there's no guarantee that there will be a pullback. So I think it is wise to wait. Look, none of this is financial advice, but I will say this. If I didn't have any position in gold or silver at the moment, I'd be heading over to sdbullion.com/new, right? Because if you don't have any hard assets at a time when this storm is about to hit, you might want to reconsider that position. Again, not financial advice. Please leave me a comment down below to let me know what you think about the coming rate cuts. What's it going to mean for gold and silver? What's it going to mean for the fate of the U.S. economy? Are we going to get a hard landing? I would love to hear what all of you have to say, so leave me a comment down below. Thanks for watching, everybody. Stay safe and happy stacking.